We're going to dive right in and unpack the principles that really separate lasting wealth from just, well, gambling. And let's kick things off with this huge warning from the father of value investing himself. Graham's whole point was that the single biggest mistake you can make is confusing the act of investing with the gamble of speculation. And trust me, this isn't just some abstract theory. It became painfully, brutally real for a whole lot of people during the dot-com bubble.
I mean, just look at these numbers. It's insane. Back in 1999, you had stocks delivering returns that looked like typos, but it was just pure speculation. It was like a giant video game where everyone forgot that stock prices are supposed to be connected to, actual business value. And by 2002, poof, it was all gone. A perfect, painful lesson in what Graham was warning us about.
So how do you make sure you don't get caught in a trap like that? Well, it all starts with what Graham said is the most important distinction of all: understanding the difference between being an investor and being a speculator. And here's the key. It's not about what you buy. It's about how you think. This right here is the heart of it. The investor, they do their homework. They analyze the business to figure out its intrinsic value, what it's actually worth. They're basically asking, am I getting a good deal on a solid business? The speculator, on the other hand, couldn't care less about the business. They're just betting on which way the ticker is going to move, hoping some other person will pay more for it tomorrow. And Graham had this absolutely brilliant way of putting it. When you're buying groceries, you're looking for value, right? You check the price, you know what you're getting. But perfume, that's all about branding, excitement, emotion. The intelligent investor is a grocery shopper, plain and simple, always focused on getting real value for their money. Okay, so to help us stay in that disciplined grocery shopper mindset, Graham came up with this incredible mental tool. It's this simple little story, an allegory really, to help us deal with the wild swings of the market. And it features a very memorable character he called Mr. Market. So here's the setup. Forget thinking of the market as this all-knowing, wise entity. Instead, just picture it as your business partner, Mr. Market. And let's just say he's a little unstable. Some days, he's totally euphoric, practically begging to buy your shares at ridiculously high prices. Then other days, he's in a full-blown panic, offering to sell you his shares for pennies on the dollar. And here's the beautiful part. You are in charge, not him. You never, ever have to trade at his crazy prices. His quotes aren't commands. They're just offers. You can totally ignore him when he's high on fumes, and you can take advantage of him when he's ridiculously depressed to buy great businesses on sale. The bottom line is, Mr. Market is there to serve you, not to guide you. Now, this idea of being able to just tune out Mr. Market's madness, well, it leads us directly to the absolute bedrock of Graham's entire philosophy. This is the single most important concept for protecting yourself, the margin of safety. To put it simply, the margin of safety is just the gap between what a business is really worth and the price you actually pay for it. See, by insisting on buying something for way less than you think it's worth, you build yourself a buffer, a cushion. And that cushion protects you from, well, everything. From your own mistakes, from bad luck, and from Mr. Market's craziness. And here is the perfect example of this in action. Back in 1973, Mr. Market was having one of his depressive fits. He offered Warren Buffett, Graham's most famous student, the chance to buy the Washington Post Company for just $80 million. But Buffett had done his homework, and he figured the business was worth at least $400 million. That massive gap between 80 and 400, that was his margin of safety. He was essentially buying a dollar for 20 cents. As Buffett himself explains it with this quote, "You don't cut things close. You don't try to buy a business worth $83 million for $80 million. No way. You demand a huge margin of safety so that if one thing goes wrong, it doesn't cause a total catastrophe. It's all about building resilience." So when you put all these pieces together, the investor mindset, Mr. Market, the margin of safety, the whole system sounds almost simple, right? But actually putting it into practice, that's where you discover where the real battle is. And it's not on Wall Street. Ultimately, what Graham teaches us is that the investor's biggest problem, their worst enemy, is probably staring back at them in the mirror. Success in this game doesn't come from having a genius-level IQ or some secret formula. It comes from emotional discipline. It's about controlling those two little demons that live inside all of us, fear and greed. And that leaves us with this one last, really provocative thought. This secret to sound investing, it's been public knowledge for decades. We know this stuff works. So why on earth do we keep making something so simple, so difficult? It seems the real challenge isn't about understanding the market, it's about understanding ourselves.